Harish Krishnan, EVP, Senior Fund Manager, Equities at Kotak AMC, is now with us on the show. Harish, which camp are you in? Are we going to clock at levels above 21,000 by the end of the year? Are we going to be settling in between 20 to 21,000? And I want to throw in one more question. I think the big fear in the market is that are we close to topping out? And based on the past precedents and historical levels, can you give us the indicators when markets usually top out and where are we compared to those?
Sure. Clearly from index levels, I don't think really we have any kind of a insight as to what it's likely to be at the end of the year. We do think that markets have run a bit ahead of themselves. And our best guess would be that we would be in a range-bound market towards the close of the year. But that's just a guess at this point of time. I think the more interesting question that you had was, with markets at all-time highs, what is it that one should do? And what is it that the historical evidence seems to suggest? So firstly, I would say that, all-time high is obviously just a statistic. So if I were to look at, say, the last 17 odd years from 2005 to 2023, where there have been about 5,000 odd trading days, Nifty, for example, has been at all-time high levels on 500 of these trading days. So that's a lot number of trading days that we've all celebrated and cheered from and benefited from as we have seen our wealth increase. There have been under 500 odd trading days where markets have been just about 1% below their all-time highs. So in totality, we are talking about 1,000 out of 5,000 odd trading days, almost close to about 20% of the total number of trading days where markets have been close to all-time highs. So therefore, it is not that, one should specifically look at all-time high at this point in time to really think about as a key decision-making variable. Of course, what is more important is that I guess for most investors, whenever we come through this all-time high, the fear is always that, are we going back to the 2007-8 kind of a level, wherein, of course, we saw a massive drawdown and it took a lot of time to recover. But leaving aside that one episode, on a general sense, drawdowns are inevitable. They do happen, but they have become a lot more shallower. Especially over the last 5-7 years, due to flows, due to better earnings, the better perception of Indian companies and the Indian economy, etc., etc. So now that's the historical evidence. I guess what is important is also to look at the current context of where things are. I think in the current context, we've gone through a phase where in the last 18 months, whatever macro curveballs can come up against, we've kind of dealt with it rather in a better way than what we would have imagined. Crude at 125, a big interest rate spike globally, a big inflation scare globally. You had a huge war that got erupted and continues in Europe. Any of these prospects by themselves would have meant a significant kind of a volatility in Indian markets. Together, we've dealt with it quite well. And which means that, a lot of the froth has gone off over the last 18 months. Yes, right. The only issue has been that, there has been some kind of an inch back in valuations. And therefore, the best sense that we have is to maintain asset allocation. We have various asset allocation products out there that help in trying to, get in when markets are cheap, and then to kind of rebalance as when markets are expensive.
All right. Hi, Harish. Morning. Talking about asset allocation, how much are you all allocating, say, into equities in your balance advance funds? What is it now? What was it? And, what's the normal average that you normally allocate out there?
Right. So, Nigel, our balance advantage fund typically operates between 20% to 80%. Just to give you a sense, in September of 21, which is when markets were at all-time high in 2021, we were at about 30-odd%. So we were close to the lows at that point of time. Then during the course of 2022, when crude rallied to 125 and the Ukrainian war got announced, and FIs were selling almost every day to the tune of 3,000 to 4,000 crores, we increased that to close to about 55%. Subsequently, markets rebounded nicely, and then we booked profits and brought it down to 40% by November of 22. And then when the Hindenburg episode happened, markets again corrected, and we had increased it to about 55% in March of this year. At this point of time, we are close to about 48, 49%. So we booked some profits, but that is at least our sense as to how we are looking at markets at the current context.
Harish, before we let you go, we're talking about all-time highs. We're talking about a fantastic market and large sense of optimism. I just want to get your sense on the inflows that are coming into mutual funds, because that is the only number that's not been inspiring much confidence. April was bad at 5,000 crores. May was worse at just under 3,000 crores. We'll get the June numbers now next week. But what is your sense? Is there a lot of profit taking or redemption that's happening at at mutual funds? What's your sense? I mean, or is the retail participant going direct? And that's a different story that's playing out as the market scales these levels.
So, Sabhi, we've seen this over the last 18 months. For example, even in October, November of last year, when markets scaled back to their all-time highs, at that point of time, flows became very less. Essentially, the way we look at flows, there is, of course, the systematic investment plan, the SIP flows, and then the lump sum flows. The SIP trend continues to remain very strong. We continue to see steady growth over there. It's the redemptions from the lump sum category that actually pulled down even at that point of time, and we are seeing the same thing happening now. And the good thing, of course, is that the Indian investor is maturing quite well, wherein when markets did correct, for example, when we saw it in January and February of this year, they did bring in a lot of flows in the lump sum category as well. So I guess there is some element of timing that a lot of investors themselves are doing in, and which I would think is a wonderful kind of a journey of investor maturity that we've seen, that they continue to maintain their systematic allocation levels through SIPs, and then basis their goals, basis their assessment of valuations, they are also trying to kind of move up and down in terms of their lump sum allocations.
All right, Harish, always a pleasure speaking with you. You have a great day, fantastic Friday ahead, and we look forward to the next conversation.